All right, guys, so now I'm going to go into the why. Basically, for my last video, and I kind of like touched on it, but I'm going to show you how my strategy actually works on any time frame. Okay, this is real trade secrets here. I just pulled up a random stock, Alibaba. What I'm going to show you is this is what real liquidity sweeps are. This is where price tends to reject. Okay, so this is how you use volume. Okay, this shit, guys. I don't know how I saw it. I just stared at charts for a fucking long ass time and really thought about like stuff. Okay, look, I'm a decent strategist. I used to play some video games, like online multiplayer games, and I would tend to do pretty well in them. I know that's kind of a side note or whatever, but what I'm saying is basically I would take whatever system, whatever game. For example, there's this one game named Fight Night, and it's a boxing game. It's a 1v1 boxing game, and I pretty much got to be like one of the best players in that game online. I got so good. It's an old game, so there were a lot of hackers and modders and cheaters who would give their fighters extra strength and stamina, and without cheating and while using a worse fighter, I would often still beat the cheaters even, because I understood the game so well that I could strategically decimate them. I would throw body shots, take their stamina, one punch at a time. I would just wait till they were tired, and at the end of the fight I would turn it up and knock them out. Anyway, there's other games too. Like there was a MOBA I played. So, I don't know if you know what a MOBA is, but it's basically a very difficult 5v5 game where you pick a hero and you basically have to use small unit tactics to beat the other team in you have to destroy their base, you have to destroy their forts and stuff, but you also have to kill the enemy players. So you have to strategically hammer away at their bases while also beating them in like ambush fights and like guerrilla tactics and stuff like that. Anyway, whatever. All I'm saying is basically like I took those scenarios and I understood how to win, and so I applied that same logic to trading, which is that it's a war and you have an opponent and you have to decimate your opponent. Okay, so you have to figure out where your opponent's weak and you have to attack their weaknesses, and you keep exploiting that until it works. So anyway, what does that mean in trading? Okay, so I'm sure many of you by now are familiar with the idea of stop hunting, which is that, well, first off, the market is a zero-sum game. So for every winner in the market, there's a loser in the market. Meaning that if an institution who, turns billions of dollars in profit a year, millions or billions of dollars of profit a year trading stocks, futures, options, whatever they're trading, that means that they have to try to use what firepower they have to manipulate price enough so that they can cause traders to lose money. And in a roundabout way, the losses from other traders become their wins. It's not like a direct, this trader lost and I won the same amount that they lost. Like sometimes it is, but it's usually more roundabout. Like this trader lost and that other trader lost, but I won, and they lost. Their losses accounted for half of the price movement that was my win, but then these other traders' losses were the other parts of my win, and yada yada, that kind of thing. It's a very roundabout method, but it's still like you can think of it directly because in the price charts it's very direct. So I'm sure you've heard of ICT. He talks about liquidity sweeps. He says that old highs and lows, liquidity will be swept and then price will tend to reverse, or it can reverse. And look, I'm not going to argue with that. That does happen. Okay, that's like the oldest trick in the book, though, for taking out sell stops. Okay, it's not that simple. What you have to think about is like maybe retail traders are doing that and stuff and getting stopped out there, but like institutions, at least the profitable ones, they don't fall for that shit. So what you're seeing here, you're seeing institutional price wars, right? So like there's multiple institutions, big institutions, and they all have power to manipulate price to some certain degree, right? But none of them has complete control over a market. So there's wars between them. And so you're not analyzing like how are institutions beating retail. Yes, there's an element of that, but it's how are institutions trying to beat each other. Okay, so it gets tricky. Okay, but at the same time, it's very simple once you see what they're doing. There's a very simple way to do it. Okay, look for the highest volume candles. Treat those candles like the opening range on an intraday chart, like I showed you on the previous video. Okay, so this is a high volume candle. What does that mean? There's lots of orders that came into the market there, which means that if price comes back to here, that's an area where there's also going to be lots of stop losses, correct? So as you can see, price trades into there and then moves away. It's that fucking simple, okay? I mean, of course, it's nuanced and they're going to be interrelated with one another, and it's not always going to work. But you remember my coloring outside the lines thing? This candle is a high volume candle. Price trades back up into it, but it turtle soups it. One candle closes outside of it. Sorry, I drew that a little high. The next candle also opens way higher. So a lot of people think about this. People panic. Their short positions from here. They panic. Did a stop loss, which would be a buy order. So they panic bought back their shorts, and then it sold off, and they could have got out break even here. Now that didn't pan out anyway. So but the reason it didn't pan out is because there was this even higher volume candle right here that it had to sell off from, or didn't have to, but it wanted to, that it was optimal to sell off from. Okay, so again, if you look at, like, for example, this candle. Okay, and so I don't know if you've heard of Kulamaji, but if you're trading his strategy, like, this is kind of how I figured it out. Was I was studying his strategy, and I was thinking, well, he trades the moving averages, but I was trying to think, like, how is price actually attacking, like, resting orders or orders during these bull flags and stuff. And so what I found out was that it would come back to, often would come out to the breakout candle, and I was like, why does it do that? And then I was looking at the volume, and I was like, oh, there's so many stop orders there, it's going to attack that. So you can see here, comes back into this breakout candle, into the volume. That's where all the orders are, right? Takes them out, and guess what it gives you? It gives you at least a, right there, it gives you a 1-to-1 of the range of this candle right there, right? So you could have taken a partial there and then moved stop loss to break even. As you can see, a lot of people probably, people in the know probably did exactly that. Now, I mean, this isn't like just it's pretty useful, but it's not just like an easy cheat code all the time, because it's kind of, volume is relative. So like this might seem like a high volume candle, but it's not as high as these. So like, will price react to this? I don't know. Let's see. So as you can see, price begins gapping down, moving away from there, trades back up into it, shorts, is gapping away more, comes back up into it, shorts, boom, comes back up into it, shorts. Okay, so that was a clearly valid candle. Okay, so I hope this opens your eyes as to how price is actually working. No one has ever taught me this though. Like this, I just had to see this on my own. I'm not some sort of like god or guru, but I am a pretty good strategist. So this is the kind of stuff that I'm able to see when I am given enough time. As you can see, price looked like it wanted to reject from these sell orders, or from these resting orders here. It didn't, punch through there, gapped away, came back up, sold off. Not a big enough gap for me to be confirmation. Gaps away again, comes back up into there. Look, it becomes an inversion level. It can't violate it, sells off. Comes again, sells off. Okay. ICT talks about inversion levels. These are the real inversion levels. It's based on volume. That's where the orders are. Would it make sense for an institution to attack a candle like this one? There's no volume there. That means they can't. There's not enough liquidity of resting orders there inherently. There could be, maybe it comes back up there and all of a sudden there's more volume, but that volume is not going to. An institution cannot get filled very well there. They can get filled very easily in this area because this is an area where there's lots of volume, and there will probably be volume again. Okay, so let's look again. Here, I don't think it came back to here yet, so that's not valid. But look, if Alibaba sells off to here, I would not be surprised if this candle, if it rejects from there. Why? Because there's a lot of volume. There's probably a lot of break-even sell stops right there from people who got lucky and bought the low, right? So if they attack those people who are lucky, who took partial profits, move their stop to break even, guess what? There's going to be a huge liquidity sweep right there, right? It's going to be passed, those orders are going to be passed off to the institution that bettered them, that bested that institution. Okay, so it's pretty simple actually. Here you go again. This one, it kind of turtle souped it, but there's only like one candle closing above it, right? So you see this big green candle right here? It wasn't super clear here. Well, we'll get to it later, but it does gap down away from it here, trades back up to it, pushes, punishes, tries to get all the people who are short selling from somewhere in this candle, scares them all out, and then it moves away. It's okay if you got stopped out, because guess what? It comes right back into that candle again. There's your short position. Okay, so it's a very simple thing. Okay, I'm giving away trade secrets here, but the thing is like, I'm not afraid to, because here's the thing. Now I showed you it on this. I'm a NASDAQ intraday trader. You don't have to be a NASDAQ intraday trader. I know in the last video I said that's the most profitable thing. I believe personally that is the most profitable intraday instrument to trade. I could be wrong. And maybe it depends on who you are, who the person is. Okay? You might be better on Forex. You might be better on stocks. You can trade it on a daily chart, a weekly chart, a monthly chart on stuff. Maybe you want to be a long-term position trader. Maybe you're an investor. If you're an investor, then let's just like look at this. I mean, look at NVIDIA. You know, NVIDIA is probably going to be one of the best stocks to ever own. It's a bit, you know, high to get in, but you know, it's probably going to keep going up, honestly. Okay, so let's look at some of the highest volume candles on a weekly chart for NVIDIA. You've got one right here, right? Let's just see how price reacts. I can't guarantee it perfectly will. You know, and again, traders will tend to do better than investors in markets if they're good. If you're not a good trader, you won't. Gaps away here. Look at that. Gaps away. Multiple candles closing outside of that. Comes back into it. Boom. Look at this here. There's another reaction. Now that reaction, you know, got turtle souped a bit. But look, again, it only violated it by one candle. And like I said, they'll color outside the lines, right? So this very big volume candle right here. So this is why like people try to trade support and resistance, but sometimes the resistance gets barely violated. Sometimes it has nothing to do with that. It's the volume, right? So I actually just picked that one randomly, but I didn't realize that that was the best one to buy to catch this bull run. So, but is this making sense? So I'm not gonna, don't let me take away from you guys. I'm just giving you a general, quick analysis of a tool of how to actually read price action and volume. This is what I'm sure all the best traders are doing. I probably shouldn't be giving this away, but guys, like, there's so many assets to trade out there. We're not gonna cause liquidity issues for each other. Even if I become a billionaire eventually trading like this, and you do too, you know, if you have liquidity issues getting filled, if your account gets too massive at some point, what are you going to do? You're just going to move to other assets, right? Or you're going to, at that point, you'll have enough money to pay enough people, build a team, and you'll figure out your own edge, right? That has something to do with this, but maybe you push that with, you know, HFTs or whatever. Okay, but in terms of growing an account to a size that, like, you know, where you'll never have to worry about money again, we're not going to cause liquidity issues for each other. All right, you only start causing liquidity issues once your position sizing gets into like the billions and stuff. Remember, markets, like, trillions of dollars flow through markets every day. So we probably, unless we're all trading the NASDAQ intraday, we're not going to cause liquidity issues for each other. So let this video be an inspiration to you. You don't have to trade the NASDAQ. Trade whatever you want on whatever time frame you want. Explore, figure it out. Maybe you'll see more nuances to this. You know, maybe micro caps will be your thing. Maybe small caps. Maybe you want to trade large caps. Maybe you want to do this, but you want to trade the options chain, right? Maybe you want to actually trade the NDX for some reason instead of the NQ, because why the fuck not? Maybe you want to trade precious metals. I don't know. Maybe you want to chart a used car market and do the same thing. I don't know if that, like, how well that would work, but who knows? Okay, maybe you want to, really, like, it's just about being creative, honestly. It's about being creative with strategy and just pushing your edge and trying to figure out, like, what's going to work best. So I see this beginning of a breakout in high volume right there. I'm thinking this candle, right, if it comes back to that, that's going to be a great buy. Guess what? That whole recession, and I hope this proves to you, I don't know if this proves that markets are manipulated or that they're just efficient. But just because a market is efficient doesn't mean it can't be beaten. Actually, quite the contrary. If it's efficient, that means it will be consistent in what it does. Efficiency will be consistent, and all you have to do is figure out what it is doing that is consistent, which I somehow figured out, and then you'll be able to trade. Okay, and there was a hater in one of my comments saying that me dismissing ICT was bullshit, and that my strategy is not that great. The thing is my strategy is great. But now it comes down to the tactics. You know, where are you going to stop your positions out? Because I say that you hold through one candle that closes below, and if a second candle closes below, then you stop out. You don't have to follow that rule. Maybe your stop is just the low of the candle, right? And then if it stops you out, then it'll probably give another signal again later, and then you'll get back in. So maybe you just rather take a smaller loss and then wait for another signal and get back in. Maybe that's more profitable. You know, I'm still figuring it out too. I only started to see this stuff within the past 6 months or so. So really, like, you can, the last video, again, I just showed you, it works really good on the NASDAQ. I said it also might not work as good on Forex. I could be wrong though. Maybe just look at whatever asset, whatever Forex market you're trading, just be aware of what time, and obviously convert it to your time zone, but be aware of the times that the markets are opening. If it's a pair, you know, you're trading a pair, be aware of both countries opening, stock market opens, and also be aware of the New York Open. Maybe with having 3 opens, maybe a 4 or 2 or 3 opens, maybe a Forex actually is more exploitable because it's got more opening. So maybe you'll have more trades to take in a day. I personally don't know. I don't really study Forex that much, but I would put it in your guys' hands to go do that then. Maybe it's way more lucrative there because maybe you can get 3 or 4 trades in a day instead of like 1, you know? So again, just take this and run with it. Maybe you want to trade treasury bonds. Like, who cares? Just find something that you think's interesting to study and do it. Maybe, I mean, I guess frozen orange juice concentrate isn't really traded anymore. Back in the up and outcry days, there was a dedicated pit of people who loved trading for frozen orange juice concentrate. The market is your oyster. Just pick an asset, study it. If you don't like it, move on. It doesn't have to be day trading. It can be swing trading. You could be trading. You could be high frequency trading if you have, you know, good commissions. Anyway, take care, guys.